Today we are tackling something that makes most of us groan. Budgeting. Most of us don't like budgets, believe they are extremely difficult, definitely boring, and even if we believe they are a good practice, we just ignore them. Well, as a business owner, you cannot afford to go doing business completely blind. So I will show you a very simple way to create a budget that doesn't involve difficult financial accounting tools or jargon. Just a little bit of thinking, common sense, and a spreadsheet. So if you're not very good with bookkeeping or accounting, or you just know you don't enjoy it and postpone it forever, this video might be the solution for you. Now, on the other hand, if you are a pro and handle QuickBooks like a wizard, then you might find this video way too basic. So for the TCs out there that have no clue how their business is doing financially, let's follow together this quick series of steps to get us to a place where we can start taking a peek at our basic finances and start making smart, informed decisions. So let's start by clarifying what a budget actually is. Some people confuse a budget with saving. You can use a budget to keep you from overspending and save money, but that's not the full extent of a budget. As a business owner, you have goals, most likely earning goals, right? Well, some people know they are getting revenue, meaning you are closing transactions and getting money into your bank account, but how much of that money do you actually keep? A budget is, in simple terms, a spending plan for the future. It can be a plan for the next month, for the next quarter, or for the next year. Now, if you're a TC that you're working already in your business and closing deals, then you're going to use the data you already have in order to project your past numbers into the future. Now, if you are a new TC and you have no data because you're just studying, then you are going to guess what these numbers are, and I'm going to help you with that. Now, this projection, this plan will be a tool that you will use to stay on track and make decisions and also make adjustments to reach your goals. I like to think of a budget as a financial roadmap. Just like you wouldn't start driving to a new destination without directions, you shouldn't run your TC business without financial guidance. Your budget tells you if you are on the right track or if you need to make a detour. Now, the step number one is to select the frequency. And I recommend that you create a quarterly budget, but then divide it into months and weeks. This will give you more detail and more control while still maintaining the bigger picture. One practical tip here is to create your budget before the period begins. That means that you're going to set aside time in the last month of each quarter to plan for the next one. Now, for the step number two, so now we need to get your sales number, which is the money coming in, pretty much. If you are a TC, you might have revenue or the total amount of money generated from different type of services. Maybe you offer open to close, maybe you offer listing coordination, maybe you offer marketing services, and all of these services are going to be your sales. Now, if you just started your TC business, you don't have any data yet, but you might estimate how much money you will get in the first month. And based on your marketing and networking efforts, how much you estimate you will be able to get in the second and the third month. You will then add them all, and that will actually be your projected sales amount for the quarter. For example, if you're just starting out, your projection might look something like this. The first month, you might expect to have 3 transactions at $350 each, which will bring $1,050. On the second month, you are planning to close 5 transactions at $350 each, which equals $1,750. And on the third month, you might expect to close 8, which is $2,800, totaling $5,600. So if you are a more established TC business and you have your numbers to compare from the last quarter or even same quarter last year, then analyze all the info and do the same work. Project how much you expect to earn this quarter. Obviously, if you are using data from the previous quarter or even the previous year, I want you to take in consideration everything that might potentially affect your projection. For example, if you are planning to take time off for whatever reason and you are not actively looking for new clients and you already lose one last quarter, then your numbers might not be exactly as they were last quarter. So analyze, make sure that you take in consideration everything that might happen and come up with a number for the next quarter. Now, I want to take a little pause to clarify that your budget might be done using a realistic projection for sales. We all have goals and dreams, but the sales projection shouldn't be based on a dream. I want you to be realistic. And if you have a pleasant surprise at the end and you make more than expected, we can just adjust without major consequences. However, if you actually inflate the sales number and you end up making less, it will be more challenging for you to adjust. So here's a pro tip from my experience. For established businesses, look at your last 4 quarters of data. Can you identify a seasonal pattern? Do you tend to be busier in certain month of the year? For example, many DCs see more activity in spring and summer month when real estate transactions peak in many markets. I want you to factor this seasonality into your projections. Also, consider any changes in your business model or service offering. Are you raising prices this quarter, for example? Are you adding a new service? Have you partnered with a new agent or brokerage? These factors should influence your sales projections, of course. Now we are moving to the step number 3. We are going to list your expenses. So in this step, what you're going to do is to list all the expenses you have and you expect to have. Okay, it's a good idea to divide your expenses into fixed ones and variable ones. Let's talk about fixed expenses. Those are the ones you have to pay regardless of how much you made or how much or little you work. For example, your internet bill, it's the same every month, regardless if you take 2 new clients, if you close 10 contracts or 2. Cell phone, the same thing. Your E&O insurance, same thing. Your professional association or memberships or your website hosting, your accounting software if you use one, your cloud storage. All of these are actually fixed expenses. On the other hand, the variable ones are the ones that can increase or decrease as needed. For example, let's say that you are planning to print flyers. Well, if you're printing 100, it's going to be a price. If you printed 2,000 this month, it's going to definitely be higher, but you can regulate that. So marketing expenses are a great example of variable, expenses, because if you put more ads on Facebook, then definitely you're going to have more expenses. For example, contract labor. If you have a virtual assistant that assists you here and there and you only pay per hour, that might be a variable, expense. Something many DCs forget to include is taxes. As self-employed business owners, we need to set aside money for taxes. As a general rule, you should allocate about 25 to 30% of your profit for taxes, depending, of course, on your tax bracket and state requirements. So make sure that you check with your CPA. Another commonly overlooked expense is your own salary. Yes, you should pay yourself, and it should be a consistent amount that you can count on. If this video is helping you to rescue your TC business from financial chaos, hit that subscribe button. It's free. And now let's move to the step 4, which is do the math. That's it. Pretty much you have to to take the total amount of sales and then subtract the total amount of expenses. Whatever is left over, you will either take as profit or reinvest in your business. Now, on the step 5, we're going to review and adjust regularly. Pretty much, you will have to review this budget every single month at least, and I will encourage you to do it weekly. If you happen to have less sales than you expected in your budget, now the next question will be, are these sales enough to cover the fixed expenses, which some people call the overhead? If it's not, we are in trouble. And this is why I was saying that you have two options. Either you decrease expenses or you increase the sales. So this is a very, very basic, but this is why I encourage you to be on top of your budget weekly, especially because it's very common for us TCs that whatever new sale or new contract we have is not going to actually turn into money in less than 30 days, sometimes even 45. Unless that you have a cash transaction, which those are super sweet, and sometimes you can close it in 2 to 3 weeks, okay? And that's the beauty of the budget. And that's why we review it weekly. Because if you are noticing that, things are happening, you have a really bad month and you have a lot of cancellations, then you might have an opportunity to take some action and make things better. And if you couldn't potentially, recover the situation within the same month, you know that for next month, you will have to do something in order to absolutely bring more sales. Hope that makes sense. Let me know in the comments if you have any questions. Monthly, I do a deeper review where I reconcile all accounts and look at my profit margins for each service I offer, because this helps me identify which services are most profitable and where I might need to adjust my pricing or processes. And next, I wanted to talk about unexpected expenses and a contingency plan, because one thing that can throw off any budget is unexpected expenses. In the TC world, this might include software price increases. Let's say you use a task management software and now they, hit you with a price increase. It could happen that you need your computer to be replaced or fixed, or maybe the contractors that you're using for certain services now are not available and you have to go with higher price alternatives. So that is why I recommend building a contingency fund in your budget. You should be setting aside, let's say, 5 to 10% of your projected revenue as a just in case fund. And if you don't use it, great, you roll it into your profit. But when you have it available, you can prevent this surprise from derailing your entire quarter. Do me a favor and drop a comment with your biggest budgeting breakthroughs. Now let's talk about how to use your budget as a decision-making tool. Because remember, the fact that you are generating money, sales, doesn't mean you're actually profitable. Not if your expenses are actually higher than what you're bringing in. So create this very easy exercise and use it to plan for future projects and additional expenses you want to take on in your business. So let me give you a real world example of how your budget becomes a decision-making tool. Let's say you are considering hiring a part-time virtual assistant for 10 hours a week at $20 per hour. That is an additional $800 monthly expense or $2,400 per quarter. Your budget tells you that you currently have $794 a month in profit after taxes. Clearly, you cannot afford the VA without either increasing your revenue by at least $800 a month or cutting other expenses to free up the necessary funds. But what if that VA could help you handle more transactions? If each transaction brings $350 and the VA help you take on 3 more transactions per month, that's an additional $1,050 in revenue, more than covering their cost. This is how your budget help you make strategic decisions rather than emotional ones. You can clearly see the financial impact before you commit. Now, let's talk about how you can integrate budgeting with goal setting. And as I said at the very beginning, I recommend you do it quarterly, but you still review it weekly. You will have to use your goals as a guide. And this is actually a great way for you to pair it with the 12-week year methodology, which is an awesome way to accomplish more in less time. If you're not familiar with the 12-week year approach, it's based on the idea that 12 weeks is long enough to achieve significant results, but sure enough to maintain urgency and focus. Instead of setting goals annually, you set 12-week goals with weekly milestones. So your budget becomes the financial backbone of this planning process. For example, if your 12-week goal is to add 5 new real estate agents to your client roster, your budget should reflect increased marketing expenses to reach these agents, potentially reduce revenue initially as you spend time on business development, increase revenue projections for the latest part of the quarter as new clients come on board. This integration of financial planning and goal setting is powerful because it forces you to think about the financial implications of your goals. It adds accountability and realism to your planning process. For more details about how to utilize the 12-week approach, click this video right here.